All right, I just want to jump straight in because I'm so excited that we're already getting some momentum. So today we're going to be talking about building exit value. This is foundational content, something that you will use from this moment going forward and probably for the rest of your life. It is a fundamental shift in the way most people think about building business, building the value in what they've created. So I'm excited to jump in. Now, last week, after I kind of punched you in the face with a bunch of tough news and some of the challenges that so many entrepreneurs face, sharing the statistics that are stacked against us, right? The challenges that we have, building our companies, scaling our companies, taking wealth out of our business, monetizing what we've created, ever finding an exit or maximizing the value in those exits, those are all stacked against us. But I also showed you these examples of some companies that were dramatically defying the odds. And in the session, the real question was, what is their secret, right? How are they able to move from these horrible odds and challenges to these life-changing outcomes, moving from that despair to great outcomes? And the reality is these companies were all sold based on their strategic value to the buyer. These were not financial deals. People often get confused because they'll say, well, they paid 80 times revenue, that's financial, or 45 times revenue, or 120 times EBITDA, or some crazy number. The reality is that it was worth over $1 billion to Microsoft to own Yammer, to have the technology that they offered them. After the deal was done, someone in the media went and interviewed the founders and said, what was the revenue at the time of the acquisition? And they're just doing the math. It had nothing to do, I can assure you, no one's ever going to walk into a company and offer 45 times revenue. It was worth $1 billion to Microsoft to have what Yammer had created. That was a strategic deal. It was not financial. So what we're going to talk about today is what I call critical shift number one, which is you have to focus on strategic value. Now, the typical entrepreneur belief, and this is pervasive, everyone talks about and asks about your last 12 months revenue or your last 12 months EBITDA. So you believe very naturally that your business's value is based on financials. Your revenue, your profits, your cash flow, your margin. And you might even be thinking, okay, Mac, that's wishful thinking on this whole strategic thing, but we all know companies are really valued based on their financials. That's what we always hear. That's what we're always asked. So I want to show you a chart that I think is really illustrative and powerful. This is the components of the S&P 500, 500 of the largest companies on earth, and what percentage of their value is based on tangible versus intangible assets. This is hopefully a really clear chart because you can see back in the 70s and 80s, the bulk of the value of the S&P 500 was created. These companies were valued based on tangible assets, things that you can touch and feel, inventory, equipment, real estate, physical touch and feel stuff. And it was 83%, 70% of the value was based on those things. As we move into the 2020s, 90% of the value of the S&P 500, Google and Apple and Tesla and all these companies that are the most known companies on earth, 90% of the value of those companies is based on intangible assets, things that you cannot touch or feel. And I can assure you, if it is true for the most valuable companies on earth, with all the analysts on Wall Street and on High Street and all the places around the world that are valuing these companies and looking at every detail, if 90% of their value is based on something intangible, it's true for you as well. So you might be saying, okay, great, what are intangible assets? Intangible assets, again, are things that you generally can't touch or feel. In a lot of cases, value is based on intellectual property, patents, trademarks, copyrights, goodwill. When you think of a company like Apple, a lot of their value is in the intellectual property around everything that they do, right? That's just where the value is. It's also in things like brand recognition. When you think of iPhone or you think of AirPods or any of those things, you immediately think of Apple, and it immediately makes you think of high quality, amazing experience, if you're an Apple fan, which many people are. And so brands are great examples of an intangible asset. Internet domain names. I was on the board of a public company that we sold a domain name, a .com, for $8 million in cash. They have real, true value. I have personally sold domain names that I bought for $19 for a lot of money, right? So there's real value in a .com, for example. Customer list, employment contracts, your intellectual capital, the human capital in your business. These are all things that are intangible and yet are what make up the value of the most important, biggest, and most valuable companies on earth. So I want you to think about this. What really creates value? If you go out to the market today and said, hey, I want to sell my business, what do you think it's worth? The questions are going to immediately go to, tell me your last 12 months revenue. Tell me about your cash flow. And of course, there's value in that. I never want to dismiss if you have a very high growth company with great financials and you're very profitable, that is amazing. That is really important and good. But the real value is often found in these other things that are why you have high revenue and why you have great profit margins. Things like unique, hopefully proprietary products and services. You have a product that is market defining or innovative and people want it. Or you have a powerful brand. There are companies all over the world that create great products, but the brand doesn't resonate with the consumer. There are a lot of Fortune 500 companies on that chart back in the 80s and 90s that the name just feels old. You don't think of innovation. You don't think of selling young consumers. So those companies, despite having billions in profits, have to go out and buy brands to attach it to their own products and services. Intellectual property, I often say, is low cost, high value. A lot of times just the trademark or the copyright that you have on a great offering or a great brand can be really transformational for companies. If you have unique or, in best case scenario, exclusive distribution, the way that you take your product to market. A lot of SaaS companies are very famous for this. They create an awesome product and then they do a partnership with someone that takes them to be the market leader immediately. Some of my own companies created value with this strategy. Loyal or unique or niche customers. And so there are a lot, again, big companies that can spend a lot of money, but you may have aggregated a very special, loyal relationship with customers that other people want. Exclusivity in all forms, contracts around real estate, suppliers, distributors, all of those things. If you find exclusive partnerships that are really powerful, they can drive great outcomes. So if you hear nothing else, and I know that won't be the case, we can always do the math in 5 minutes. We can look at how the market is likely to value your company based on very traditional financial metrics, and you could probably find a buyer right now that would be willing to pay you 3 to 5 times EBITDA, maybe even a revenue multiple or a big EBITDA multiple, depending on your industry, your company. But I'm telling you, as it is highlighted, if you sell your business based on financial metrics, you are going to leave a lot of money on the table. You need to build your business and think about your business and sell your business based on strategic value. Now, I want you to let this stuff sink in. If you have to listen to it multiple times, please do. Go back to that if you need to. But who are the buyers? One really big mistake that so many entrepreneurs make when it comes time to think about selling their business is they talk about and talk to financial buyers, private equity, groups like that, or maybe one or two other industries with their own industry being the point of focus. So if you're a $10 million vitamin and supplement brand and you want to sell your company, the path of least resistance is talk to private equity and find a 50 or 100 or 200 million vitamin and supplement company that wants your products. But the reality is the greatest multiples often exist when someone outside your industry is looking to break in. Now remember the list that I showed you not long ago. These are some high profile examples, and we said these are all companies that were sold based on their strategic value to the buyer. That's why they defied the odds. But the other thing they have in common is every one of these companies was sold to someone outside their industry who was trying to break in. And the example I love of all of these, my favorite is Google, right? Because if there's a company on earth that doesn't need revenue or profits or even cash because they have more cash on their balance sheet than they can spend in a lifetime, Google was getting their butt kicked by Apple and the iPhone. So they needed and wanted to break into the phone business to compete with Apple. So how do they do that? They buy a division of Motorola. It's worth over $12 billion for Google to be able to answer the question, how do we enter this new industry? How do we get into the phone business? So the best deals are often when someone outside of your industry is looking to break in. Now let me give you a real quick personal example. So I had a company many years ago called Mountain Khakis. If you don't know the brand, you can think of companies like Patagonia and the North Face and Columbia in the outdoor industry. We sold in about 1,000 retail stores in the United States and of course online. And the business was growing so fast that we were really struggling to finance growth. So we had to make a decision, raise capital to compete with these multi-hundred million or in some cases billion-dollar brands like the North Face, or sell our business. Now, despite what I just said, we initially took the path of least resistance. We talked to Yvon Chouinard at Patagonia. We talked to VF Corp that owns the North Face. We talked to the family that owns Columbia. And all of them were interested in buying Mountain Khakis. But then we found out that there was this company that was called the Freedom Group. And the Freedom Group was venture-backed, and they had invested heavily in guns and ammo. And no matter what your opinion on guns and ammo in the United States is, it is a very big business with a very big PR problem because the world is very divided on you're either pro-guns or anti-guns in most cases. So this company really needed to soften their edge. And the way they wanted to do that is they wanted to move from these hard goods like guns and ammo and knives and all these things into soft goods or the softer side of the industry, hiking, camping, fly fishing. and they needed a national brand to signal to the market that they were moving into this new category. So they're outside the industry trying to break in. Ultimately, we sold 75% of mountain khakis for more than double what everyone inside our industry was willing to pay for 100% of the company. And then we sold the other 25% later. So again, someone outside your industry looking to break in. Now, when you start thinking about this is going to be really core to our time together, is we have to start thinking very broadly about, therefore, who would be interested in buying our company, who might be outside of our industry. So where do you start to look? Yes, competitors should always be on the list. Your own industry is an obvious buyer of your business, but you should also broaden out and look at suppliers and vendors. In some cases, your customers. You might have a big customer that really needs what you've created. There are public and private companies in all kinds of related or tangential industries just to the left or right of where you are. If you're vitamin and supplement, maybe it's not vitamin and supplement, it's general healthcare or functional medicine or traditional medicine. Those are becoming tangential industries. They're not exactly your space. They're tangential. They're beside it, but they're still related. There are all kinds of diversified holding companies that are looking for unique things. In some cases, they might have a very seasonal business that does all of its business in the summer, and they're looking for something to give them a winter business. And if you help them with that, it could be a great solution. If they're in the United States and they want to be in Europe, and you're in Europe, it could be a geographic solution. There are also fundless sponsors and search funds growing at a very rapid pace. These are groups that back an individual who might be a successful executive that goes raises money to find a company to buy. And you can hand them a business with a little bow on it, and it's a perfect fit. And at certain sizes, don't forget that individuals and family offices, so ultra high net worth individuals, there are a lot of people on earth today, a lot of billionaires, a lot of individuals or families that are worth hundreds of millions of dollars. And for them to buy a business at 10 million, 20 million, 30 million, 50 million, even 100 million is not only not unheard of, it's becoming pretty common. And those, sometimes they're looking for things that they're passionate about. Sometimes they're looking for something for someone in the family to run, right? So these are very different types of buyers that could, in fact, be interested in your business. So I want to share an exercise with you that I believe is one of the most powerful tools that we have in our arsenal. And it is called the Solid Gold Buyer Sheet. Now, this sheet, and you'll see a link to it, is a very simple Google sheet. There is nothing innovative or technical about this. It is basically a way for you to start to brainstorm and think about who might buy your business and why. And the primary purpose of this is to open up the aperture so that you're thinking of course, maybe they're financial buyers, great. Maybe your own industry, great. But we're looking for 3 to 5 more industries that might represent good buyers. And I say might because this is really important. You don't have to know that they want to buy your business. You don't have to know anyone in these companies. You don't have to know any executives. You just have to have a theory or a thesis that in your mind says, here's why I think this industry or these companies in this industry would love to have my company. They would love to have my customers. They'd love to have my East Coast location. They'd love to have my brands, whatever it is. So you'll see on the sheet, and there's an explanation. There's a video right at the beginning. So when you open it up, watch the video. It explains how to populate the Solid Gold Buyer Sheet. I'll leave you with this. I call it the Solid Gold Buyer Sheet because my experience personally and with hundreds of entrepreneurs that I've coached is that as you start populating this over time, you will find more and more ideas, more and more reasons that people might want to buy your business. And you start filling out, and this becomes more and more data and information. When it's time to sell your business, it's almost like it just bubbles up little pieces of solid gold of that's why that company would love to buy us. That's why that industry is a perfect fit for us. And that's what we're looking for, a very broad, unique set of people, ideally outside our industry, that are trying to break in. So this is a fantastic exercise that you'll use from the day you start, which is today, till you sell your business, and you'll use it on the next 3 that you build in the future. It is a great tool. The only other thing I want to share with you, exercise-wise, is a value driver spreadsheet. This spreadsheet is quite simple. It is just to help you start to think about and identify where value might be hiding in your business. Because if you're mentally trained and focused on revenue and EBITDA, you want to continue to build your business, of course, but you want to start looking at some of these other categories. What do we have product-wise that could be valuable or interesting? What about our customers? Is there anything unique or important about them? What about geography? And so on and so forth. So as you start to fill this out, it just opens up the aperture of where value might be hiding in your business. You do the work. Do these exercises. Even if you just get started, momentum means everything. Keep your head down, focused on getting this done, and it's going to change your business.